80% of property investors don't do this. So what am I talking about here today? The thing is, as property investors, what we want to do is maximize our income. And one of the ways to maximize our income with our property investments is to be very tax efficient. So we're so lucky here in Australia as property investors because there's one thing the government lets us have in relation to property investing, and that's depreciation on the buildings on our land. So, hi, I'm Michael Sgarbossa. Welcome back to my video with me today. I'm here sharing with you all the things that I've learned over the last 20 years to help busy people put in place low risk strategies that are easy to do to get you great financial results. How do I know this? Well, I'm a busy person myself. I have a career in railway engineering and construction, very busy in that career. I don't have a lot of time to be researching all sorts of or putting in place all sorts of crazy ways to invest money. I'm just looking for the simplest things for us to do. And I'm here to share that with you. I've been researching this for over 20 years and I've found the best ways. I've learned some of the things the hard way, and I want to make sure that you don't learn the hard way as well. So with that, I'm not a financial advisor. Just note that. These are things that I've learned to help you on your journey so you can ask the right questions yourself with your financial professionals. Anyway, getting back to what I'm talking about today, and this is the 80% of property investors don't do this, and this is about claiming depreciation on your property. So it's a great way to increase your income, because if depending on the property you buy and the age of that property, you could actually increase the income on your property by up to 20%. That's quite a lot. In most respects, if you know something about property yields, a lot of residential property yields are usually between 4 and 6% if you bought well, and that equates, particularly for a new property, as an extra 1% of yield. That's a 20% increase. That's massive. Why would you leave that on the table? But you can claim varying levels of depreciation across most property types and depending on its age. So what I'll do today is I'm going to get into depreciation a little bit and just educate you a little bit on what it is and how you can make this an advantage for you. So I'll just share my screen. Okay. So what is depreciation? So depreciation is simply with age, the building structure and its assets wear out, which means they lose value. And this is known as depreciation. Just like you buy a brand new car, with age, it gets older, it loses its value. So the government suggests it's the same thing that happens with our buildings as well. But the great thing about this is with property, your property is increasing in value over the time, mainly due to the land component and the market pressures, but your assets are on that land are depreciating. So what is depreciation really? It's a non-cash tax deduction. And what that means is you don't have to spend money ongoing to be able to claim it. Okay, so that's what depreciation is. 80% of property investors do not claim it. It's unbelievable. Why would you leave that money on the table? So I highly encourage that it's something you should add to your property investment portfolio. So there's two categories of depreciation. One is capital works depreciation. Now, this is all about the property structure and the fixed elements that are deemed part of the house. So what do I mean by that? I'm meaning the building structure itself, the roof, the walls, the wiring that's internal to the house, all of those types of elements. Okay. Now, this isn't just for new properties. It also, if you've got an old property and you've done major structural renovations, alterations, or additions, you can also claim that too from the date that you've done those additions, which is a great advantage. Okay. So just if you own an old property, it doesn't mean to say that you can't claim it. Maybe you've done some alterations or renovations in recent years. You should get that surveyed and start to claim that. Now, the other part of it is the plant and equipment. So what do I mean by plant and equipment? This is all the additional fittings that are made to the basic structure of your property. So, we're talking floor coverings, carpets, fans, dishwashers, air conditioners, all of that sort of stuff. So that's the other part of the depreciation that you can actually claim as well. So you can see here that there's a lot of advantage to be had. So just moving on, there's a few tripwires. So there's some rules that you've really got to be aware of around claiming depreciation. And this is something your accountant could help you with, absolutely, and should know about this if they know about property investing. So the first one around capital works depreciation is you can only claim it on new properties or renovated properties purchased after the 15th of September 1987. Now, you may have an older property before that, but if you've renovated after that date, you can still claim depreciation on those new elements that have been renovated. So that's one thing that you've really got to look out for, and this is why new properties are actually a big advantage. There's another reason for that right here around the plant and equipment depreciation. So with established property, something you've got to know if you're buying established property is that if you purchase it now or you've purchased it after the 9th of May 2017, you can no longer claim that plant and equipment depreciation in relation to that property. Though for new properties, you can claim. There's no restrictions that apply here. There's no date that apply. You can still claim your plant and equipment depreciation. And that's a great thing. And why does the government do that? Well, there's a housing shortage here in Australia. One thing that we're behind on here in Australia is building new properties. So the government is giving you some encouragement or some extra, extra incentives to, as property investors, if you like to invest in new property, to build new property. It's that simple, really. And the third thing is the duration. Okay, so the duration is over 40 years from the time that the property is new, or the alteration that's been made, or those new plant and equipment that new fans or dishwashers you might install into your property. Okay, so it's over a 40-year period. So property is a long-term investment, and this is recognizing that fact. Now, how do you claim all of this? Well, it's pretty simple. You need what is called a depreciation schedule. Okay, so this is prepared by registered quantity surveyors who are experienced in depreciation surveys. So there's a number of companies out there. You can link up with them, you ring them up, you arrange to them to do a survey on your property, and they'll do the schedule for you. What you do off that schedule, you then provide that to your accountant to be able to do your tax return. And that way you get the depreciation tax rebates for your tax return. It's all laid out. Now, what I will do here, just to be a bit more practical today, is I'm going to share with you a depreciation schedule of one of my properties, so you can just have an idea of what this looks like and what you could be claiming. Okay, so here's a depreciation schedule. Depreciation.com is the company I've used in this case. Not endorsing them in any way, but they've been very helpful for me, and I've been quite happy with their service. So if you want to give them a ring for your own purposes, that's entirely up to you. You can see here is a quick summary on the property address. This is in Queensland. When I bought it, what I paid for it. And then you get into a summary. You can see here the building summary, so it's the structures that I was talking about, and plant. So there's a summary here on the next 5 years. And there's a couple of different methods here. I'll just go to the next page to talk about this a bit more. So there's two methods here. There's a method called the diminishing value method and another method called the prime cost method. Now, if you just have a look at the yearly totals of both of these, you'll see that the diminishing value method in the early years gives you a lot more of a hit in regards to your tax deduction. So if we have a look at the year of 2016-17, which is the first full year that I've owned this property, if I use the diminishing value method, I've got a non-cash deduction of $8,644 that I can use, as compared to 6,491 on the prime cost method. Now, I personally like to use a diminishing value method because in the early days when you first buy property, your costs are high, your rents haven't appreciated yet. So to get that little bit more cash flow in those first few years is actually quite handy. And it gives time for rents to start to rise up a bit, and so you can increase more income over those early years as I compare with the prime cost method. In those sort of about 5 years, you can see you've got a little period there where you get a little bit more on the prime cost method. It's not a whole lot, as you can see. If we look at 22, 23, roughly 5.5 versus almost 6.5, it's not a big difference. But then when you get the 10 years plus down the track, it starts to get pretty close, and then it just continues on around that, for this particular property, around that $5,000 mark, all the way to 40 years. Now, this here is pretty good because when you look at 2016-17, that 8644 that we've got there, if you're on the top tax bracket, 40 cents in the dollar, so which I certainly am, That's actually a fair bit back there. You're getting, roughly half of that back. So you're talking around $4,000 back in a tax deduction. It's actually a bit more than that. With rent at the time, I think with this property was around about $420 a week. When you add that up over the course of a year, that extra $4,000, about a 20% increase in your property income. So particularly for new property, you can see that you get the full whack of the depreciation schedule. So this is a new property. With older properties, you won't get as much as that. This is just one of the advantages of buying new property. So I hope you find that really useful. You can see here it gets into a bit more detail around the assets. We're talking air conditioning, carpets, dishwashers, window blinds, ceiling fans, hot water systems, cooktops, range hoods. There's a whole lot of stuff in here. And this is why you've got to get experienced quantity surveyors to come and survey your house and do this for you. Okay, so that's very, very important. And it just goes on here. This is the prime cost sections. It's just the same stuff over and over again. So I hope you have found that rather useful. So yeah, that is property depreciation. My property investor friends that are out there, very useful thing to do. Make sure that you actually get yourself a depreciation schedule and claim that. Yes, it is. It seems to be the case that only 20% of property investors out there, so 1 in 5 property investors, actually effectively claim their depreciation. It's crazy. Why would you own an asset and then not claim all the tax deductions you can possibly get to increase your income? So I hope you found that really, really useful today. If you've liked this video, if you've gotten a lot of value out of this video today, please feel free to like it, share it with other people that you know will get benefit out of this. And also you'll see in the description and the link of this video, I've left a link to my website, michaelsgarbossa.com. And what I've got there for you is a free PDF that you can go and get. And it gives you the basic plan for busy people like myself to be able to set yourself on a path to invest in property. So it talks about the way I went from zero savings to buy my first investment property quite a few years ago. So I hope you find that really interesting as well. I hope you've enjoyed this video today. Thanks for joining me and take care, and I'll see you again next week. Thanks. Bye for now.